Hey, good afternoon, everybody. Marty Mazzori here. It is after the close on Monday, the 7th of April, 2025, with yet another video commentary for you. Today, I wanted to spend just a few minutes and talk about bear markets and bear market rallies. And I'm going to feature the last couple that happened during recessions, and rest assured that what I'm about to illustrate for you is consistent among bear markets since the beginning of time. And the reason for this is for you clients just to kind of gauge your expectations. In this technology/internet age, more and more of you are watching the dynamics and watching your portfolios on a daily basis. And I think it's very, very important that I help you keep perspective, keep all of this in context. Having done this since 1984, essentially spent my adult life in markets, studying markets, understanding markets, and not just the past 40 years, but throughout market history as well. So the dynamics currently have us leaning toward the prospects for a recession and a bear market that isn't even remotely done doing its work just yet. So let's just do this optically or visually. In front of you is the S&P 500 during the early 00s and the bursting of the tech bubble. Okay, and I have my measuring tool here that essentially shows us the movements in the market. And so what I want to do is just kind of show you how in a typical bear market, stocks kind of stair-step their way lower. So you can see right here, I've got it dialed up to about the decline we've seen so far this year, almost, and a little bit worse than that if you go back to the February 19th top. So right here we see from the top in the market back in March of 2000, we see an immediate dip and we see the market claw its way back almost to the all-time record, and then it failed and rolled over. And right here, when we had, say, nearly a 16% decline, the market bottomed intraday and set off what would be a several-day rally, and I would say that probably retraced, a good 8-9% of the decline. And then it promptly rolled back over to where we now have a 19% decline from the all-time high, and then another, I'm sure, 10% or so rally off of that bottom. And then it rolled over again, and it came down to a 30% decline intraday. And I'm sure folks were thinking it can't get much worse than that. And sure enough, we had a really nice rally, tried to give it back, and then boom, a 19% rally in stocks. And make no mistake, folks were piling in right in here. And again, I'm sure that they thought the worst was over, or a lot of people did. Problem is this red shaded area in here, that's recession. And the problem is what happens to company earnings and to stocks price to earnings ratios during recessions. So I'm sure that right in here, we didn't know it. Recessions are always officially called in retrospect. But looking back, in retrospect, we know that the recession was already happening. Therefore, corporate earnings were about to take quite the hit. Okay? And you've heard me say over and over again that this market isn't remotely discounting what happens to corporate earnings during a recession. So we came back, rolled back over again. Then we were later in the recession down 39%. Now, it's not unusual for a market to bottom during recession. The uniqueness of this particular bear market is that it began with virtually all-time high valuations, particularly in the tech sector, and a massive amount of concentration in tech companies, kind of like we have right now. Okay, so we're down 39%. We saw a 22% rally over the next 3 or 4 months, the fourth quarter of 2001, only to roll over actually 2 more times. First one saw the market down 50%, rallied back 21%, then rolled over and finally bottomed for good with a 50% decline in the S&P 500. Let's take a look at the great financial crisis that took us from late 2007 into early 2009. And you can see similar dynamics. From the market peak in October of 2007, we saw a 20% decline in the S&P 500. And then we got a nice, one of those rip your face off rallies to the tune of 15% over the course of about 3 months. But then the market proceeded to fall again into July. Now the market's down 24% and bottomed right there and kept rising until we were up 9.3% over the course of about a month or so. I suspect a lot of people thought, or at least hoped, that the worst was over. But as we know, that wasn't. And the market rolled back over again. And next stop was November of 2008, with now a whopping 53% decline. And had to be over by then, right? Because the market rallied, and within, a month and a half or so, it was up 27%. But unfortunately, that wasn't quite it. Needed one more thrust lower, which took the market down, call it 58%, before it ultimately bottomed for good. So, folks, here's the point I'm making, and let me just pull it forward. Bear markets generally see massive counter-trend rallies. And as I've said, I do believe that it's very likely that a new bear market has begun. So if we take the current one from the peak, and the textbook would tell you that a 20% decline is a bear market. You can see from today's low, it was 21.35%. From the close, didn't quite get there, 19.42%. Now, if we didn't have such strong recessionary conditions, I would probably be, maybe not backing up the truck, but I would be making purchases in here in a low odds of recession scenario. But that's not what we have. We have we think, relatively high odds of recession. So folks, my message here, at least at the moment, is that we should expect, really truly expect, big whopping rallies. But until the macro data really improve to the point that says a brand new continued expansion, or the odds of such, largely override the risk of recession going forward, we need to continue to hedge and watch what we do. Not that we won't try to, in fact we are, take positions that give us a little more upside oomph on a short-term basis. So now the next question I think to ask is, how bad really can it get? And what should we expect in just an average bear market scenario? Well, one way to simply apply math to it would be to simply take where price to earnings ratios tend to bottom out on average during bear markets during recessions in this case, and what happens to earnings growth rates using the S&P 500, for example. So when you take the average PE, which is around, I'm going to say around 15, it's been all over that number, but 15 I think is a good average, to where the price to earnings ratio, that valuation metric, goes in a kind of a garden variety recession/bear market. That's about 28% lower from where we are right now. Now, earnings growth tends to contract in the neighborhood of 10 to 20%. If I'm generous there, and I just say a 12% earnings growth hit to the S&P 500, when you add those together, and when you do the math associated with that, basically you get what amounts to a 37% decline from where the market closed today, or from the all-time high, roughly a 50% decline, very much like the last two recessionary bear markets. Now, does that have to happen? Of course not, unequivocally not. Will the powers that be do everything in their power to try to limit that long before we get that low? Of course they will. In fact, I think we're going to see them try at least with rhetoric, as we speak or over the next few days. I think they are rattled by this 20% sell-off in the S&P. The problem is, this is always the case. They've always tried to do that. And once the market sniffs out recession and earnings disappointments come in, stocks tend to continue to fall. But as the powers that be step in with stimulus, the president said today that he's going to try to eliminate capital gains taxes entirely in 2025. Now that by itself sounds incredibly bullish for stocks. And of course, I think it is. But of course, it would also incite some selling initially. I know it would here. We have clients who have been holding on to shares of technology stocks that we would like to reduce in terms of overall exposure, but the tax hits are something that they just don't want to stomach all at once. That would be an opportunity to clean up a lot of things. And I don't think that's unique to just us. But, yes, of course, it's bullish for assets in the long-term scheme of things. It is, of course, a headwind for a government that wants to dramatically cut the budget deficit, right? Cutting revenue streams amid record budget deficits is an interesting proposition, and we'll see how that goes. They're going to have significant spending offsets and or believe that they can grow the economy so rapidly that there'll be lots more tax revenue generated as a result. Of course, all that remains to be seen, and of course, Congress would have to approve that one. So what do we think? Well, we think that this is a good idea to do this math and to anticipate a worst-case scenario. Now, I believe that COVID set a whole new precedent, and I think we live in a new populist regime that's going to go on for decades to come. In that scenario, government steps in more aggressively and perhaps sooner than they otherwise would have been able to from a political feasibility standpoint in the past. Notwithstanding the problem with the budget deficit and the problem with inflation as a result of overstimulating, I do think in crisis times we've set a whopping precedent that says that there's almost no limit to what the powers that be can get away with politically if indeed things really begin to crumble to this extent. So we're going to have to be very tactical, and I suspect take positions from an overall global asset allocation / equity perspective and start nibbling at some value. And we've actually been doing some of that already. But until the macro concerns that we have play themselves out, we are going to want to continue to hedge against something significant to the downside. There will come a time, folks, that we will not be spending money on insurance for the portfolio. I can virtually assure you of that, because I do firmly believe that there's going to be a time when valuations make sense, the macro makes sense, and we will be comfortable just with a well-diversified portfolio without options hedges. Right now, they've been golden for us, but again, they have to be managed, and it's not something we would do if conditions didn't dictate or virtually demand that we do. So, folks, in a nutshell, just wanted to set the stage for, I think, some significant bear market rallies to come. We saw one today. I think it was a 5+% turnaround on simply a question that a reporter asked. The answer would not have turned around the market. It was simply the question is, would the president consider a 90-day delay in the tariffs? And Scott Bessent said basically no. But all day long, we've been seeing like the capital gains comment by the president, Scott Bessent saying that a lot of negotiations are going to be happening here over the coming weeks and so on. You can tell that this stuff is beginning to get under the administration's skin. And I think they are more than ready for a relief rally. And based on today's move, based on a simple question from a reporter, we know the market is going to be willing to give them that if they can give the market just some glimmer of hope that the trade war isn't all that it is feared to be going forward. But again, as I keep saying, the data are yet to reflect even what's happened so far, and even where corporate sentiment and so on suggests how it's going to be showing up in the weeks and months to come. And that's that recession scenario that we have to be very, very aware of and compensate for in our asset allocation. Folks, I'm going to stop there. Thank you, as always, for watching and listening, and I'm certain I'll be talking to you again very soon. Take care. Bye-bye.